we'll start with a very important reading for FRM part 1 that deals with fixed income analysis. So in part 1 of this reading, we'll study about bond fundamentals, bond valuation, and the very important concepts of duration and convexity. So when we start any business or a company invests in any project, it needs to fund that project. So let's say $100 is required to put up our factory. That funding, broadly speaking, can come from two sources. Equity is the money invested by the owners of the business. Let's assume in this case $50 was given by the owners, and debt is given by a bank or other lenders and has a slightly different claim than the owners, as we'll discuss. So in our project, $50 came via equity and $50 came via debt. The agreement with equity holders is that all residual profits, residual implying after the payment of taxes, interest, employee expense, any other expense, all residual profits belong to the equity shareholders. The agreement with the debt holders is that they do not participate in the residual profits. However, they are guaranteed a fixed payment. So these fixed payments are defined in terms of the coupon rate that is paid as a percentage of par value and the time to maturity, that is the time at which the par value or the principal amount will be returned. Let's say, for instance, that this debt, which had a par value of $50, has a coupon of 10%, which is paid annually, and has a time to maturity of 3 years. Then the fixed cash flows from this fixed instrument, for this fixed income instrument or this debt, would be $5 at the end of year 1, another $5 at the end of year 2, that is simply 10% of the par value of 50, another $5 at the end of year 3, and at the end of year 3 he also gets his principal back of $50. So debt and debt-like instruments are called fixed income securities because the cash flows from these securities are fixed unless and until a default happens or the company reneges on its obligation. So the company's profits may be very high or they may be very low. The debt holder is entitled to his payments that were decided on the issuance of debt or when the company borrowed the money. Debt holders are lending money right away. In a way, they are also investing in the company, and they get fixed returns in the form of coupons, and their investment is also returned at some future date in time. Now, companies of different types issue debts of varying maturities or varying coupon rates. A holder of a debt security or an investor of a debt security, somebody who's given a loan, may wish to trade this security or sell it to somebody else. So if a third party has to put a value to this instrument or to this debt, then he will compute the value of this instrument by discounting it back based on the current rates of interest. These cash flows are fixed. However, the interest rates in the economy keep changing. Let's assume there is a constant interest rate across maturities. So 1 year, 2 year, 3 year, all rates are the same. Let's call them R. then the price of the bond or the present value of the bond would simply be the discounted back value of all cash flows expected from the bond. So that's the principle behind bond valuation. We'll study that in a little while after we understand the different types of bonds. So fixed coupon bonds are the bonds that we just discussed. So they pay a fixed percentage of the principal every period, which is called a coupon, and they also repay the principal, that is a one-time payment at maturity. Zero coupon bonds, as we'll see, pay no coupon. They only return the principal at maturity, and hence they trade at a discount. That is, the price we will pay to purchase these bonds will be much lower. Annuities pay a fixed amount of time or a fixed amount over time. So the interest and the principal is packaged into one payment, something like your car mortgage or your house mortgage, that is made over time. Perpetual bonds are annuities forever. So these are annuities that will keep coming till perpetuity. Floating coupon bonds have their coupon rates dependent on some reference rate, like the LIBOR or the MIBOR or some rate, as we will see. So as the rates change, the coupon payments on these bonds also change. Structured notes can have more complicated payments. Inflation protected notes have their par value indexed to the consumer price index or indexed to inflation. So as inflation goes up, the par value of these bonds goes up. Automatically the coupon will also go up because coupon is a percentage of the par value. If inflation goes down, the par value will go down, so automatically the coupon will also go down. So these are some types. There are many other types of advanced structures also that can be created. The process of bond valuation is simple. It is a three-step process. Step 1 is to estimate the cash flows from the instrument. In fact, this is the process of valuing any asset, not just a fixed income security. So the first step is to estimate the cash flows. The second step is to estimate a discount rate or calculate the discount rate that is applicable to those cash flows. And the third step is to actually discount the cash flows back and calculate the price of the bond. So it can be mathematically represented as the price of the bond is summation t equal to 1 to 10 the cash flow from the bond in a particular period. So cash flow in year 1 upon 1 plus y to the power 1 plus the cash flow in year 2 upon 1 plus y to the power 2 plus cash flow in year n upon 1 plus I to the power n. Cash flows coming further out will be less valuable and will be discounted more. So CT is the cash flow in a particular period. T is the total number of periods. Capital T is the number of periods to final maturity. Y is the discounting factor per period. Please note that unless otherwise specified in questions on bonds, we will assume semi-annual compounding as a rule of thumb. That is, we will assume coupon is paid twice a year, once at the end of every 6 months. And the corresponding discount rate is also semi-annually compounded. So if 8% is a semi-annually compounded rate, then every 6 months we will be discounting back by 8 by 2. If 10% is the annual coupon, then every 6 months we will receive a coupon of 10% by 2. So remember, the coupon rate as well as the discounting rate are annualized. However, they are semi-annually compounded. So the three items we discussed define the cash flows of a bond. The three items are the coupon rate, the par value, and the time to maturity. So if we know these three factors, then we can estimate the cash flows from the bond. Another very important calculation is the calculation of the yield to maturity. The yield to maturity for a bond is defined as the discount rate that makes the present value of all cash flows of a bond equal to the price of the bond. So if a bond has a par value of $1,000, a 6% semi-annual coupon, and 3 years to maturity, compute the bond values when the yield to maturity is 3%, 6%, and 12%. So computing the bond value when the yield to maturity is given is straightforward. We need to discount it back by this rate, because this is the discount rate that makes the present value of all cash flows equal to the price of the bond, which is what we have been asked to calculate. So the cash flows are 1000 into 6% by, that is equal to $30 at the end of every 6 months. So at t equal to 0, nothing is coming. First cash flow comes at t equal to 0.5, second at t equal to 1, 1.5, 2, 2.5, and 3. So $30 come at the end of 6 months, another 30 at the end of 1 year, so on and so forth till the end of year 3, when we also get our principal back, and our principal is the par value of $1,000. So we get $30 plus we get $1,000 back. Each of these cash flows will be discounted back by a semi-annually compounded rate that is called the yield to maturity. So for the first cash flow, there is one 6-month period, so it will be discounted back 1 plus y by 2 to the power 1. For the second cash flow, it is coming 2 semi-annual periods away, so it will be discounted back by 1 plus y by 2 to the power 2, 1 plus y by 2 to the power 3, so on and so forth. The last 2 cash flows, that is the coupon as well as the principal repayment, will be discounted back by 1 plus y by 2 to the power 6. Now the question has given us different values for the yields, and we are asked to calculate the price of the bond at t equal to 0 under different circumstances. So we will take help of the time value of money sheet to help us with the calculation. So we see that n, that is the number of compounding periods, in this case is equal to 3 into 2. There are 3 semi-annual periods, that is a total of 6 periods. The discount rate in the first period is 3 by 2, that is 1.5. The payment at the end of each year, please know that is the number what PMT stands for, is $30. In the future, we are also getting an additional $1,000, that is the principal repayment, and we are asked to compute the present value or compute PV. So let's input the values. Press 6 and press N, press 1.5 and press I by Y. Ignore PV, press 30 and press PMT, press 1000 and press FV. Press the button compute first and then press PV. So we get PV as minus 1085.45, which implies that if we invest $1085 in this bond, then we should effectively realize a yield of 3% or a rate of return of 3% over this 3-year period, assuming all of these coupons are also reinvested at the rate of 3%. So the yield to maturity is the return that you would have actually made at the end of 3 years if all coupons were also invested at the rate of 3%. If you invested them at a higher rate, you could have made a higher return. If you invested them at a lower rate, you could have made a lower return. Yield to maturity assumes that coupons are reinvested at the rate of return or at the yield to maturity. Similarly, we can do and verify the calculations for 6% and 12%. Only thing we need to change is the I by Y. So for 6%, I by Y will be equal to 3. So just press 3 and press I by Y and compute PV. All other values have already been entered. Please note that this now becomes a par bond because the coupon rate is the same as the discount rate. So 6% is what we're getting as coupon, and 6% is also our discount rate semi-annually compounded. So if coupon is equal to the par value, that means we're discounting back by the same interest that we are getting. In such a case, the price of a bond will be equal to the par value, and we can verify it from our calculations as well. If the discount rate is higher, for example 12%, on a semi-annually compounded basis, we'll press the button 6 and press I by Y. And then when we press compute PV, we see the bond now is available at a big discount, or for a price of about $852. So if you buy this bond today for a price of $852, then you will receive the same fixed cash flows, implying a return of 12% annualized over a course of 3 years, assuming the coupons were also reinvested at 12%. The relationship that we've just derived is called the price yield relationship. We saw that when the yield was 3%, price was high. At a yield of 60%, price was equal to par value. And as we increase the yield further, price fell down further to 85.2. So we see that the price yield relationship is actually an inverse relationship. As the yield to maturity is going up, the price of the bond is going down, logically so, because the discount rate is going up. So the discount rate goes up, the value of the instrument will fall. For each of these bonds, if we kept reducing the time to maturity, to begin with it was 3 years. If we reduce the time to maturity to 2.5 years, and then to 2 years, only n, everything else was constant, only n was continuously being reduced, we would have seen that at maturity, the value of all bonds is equal to par value, because no matter what the dividend amount was or the coupon amount was, at maturity there is only one payment remaining, which is due instantly. Hence remember, at maturity the value of all bonds is equal to par value. So the value of the first bond will move down from 1085 to par value. The value of the par bond will remain there, and the value of the 12% yield bond will go up to a value of $1,000, because when only an instant is remaining before maturity, at that point the value of all bonds is equal to par value. This phenomena is called the pull to par phenomena. That is, to begin with, the bond could be at a premium or it could be at a discount. However, as time passes, the value of all bonds equal their par value. We are assuming there is no credit default. Compute the value of a 10-year $1,000 face value 0 coupon bond with a yield to maturity of 9%. Now it's a 0 coupon bond means that between year 0 to year 10, it is not giving us any cash flow or any coupon. At the end of t equal to 10, we get our $1,000 face value back. Please note that since no information about compounding is given, in questions on bonds, unless otherwise mentioned, we will always assume the compounding to be semi-annual. So since we don't have an annual rate, we will discount it by the semi-annually compounded rate of 9%. Hence, the value of the bond would be 1000 upon 1 plus 0.09 divided by 2, that is a 9% divided by 2. However, for 20 semi-annual periods, that is a 10-year span. This can also be written as 1000 upon 1 plus the semi-annually yield, compounded yield upon 2 to the power 20. So n will be equal to 20, since 10 years means 20 semi-annual periods. I by y would be 9 by 2, that is 4.5. PMT would be 0, FP would be 1000, and we would compute PV. So let's do it. Press 20 and press N, press 4.5 and press I by Y, press 0 and press PMT, press 1000 and press FV, compute PV. So we see that for a par value of $1,000, this bond has a price of just about $415. Hence, zero coupon bonds are also called deep discount bonds. Since they are not paying us any coupon, all the return that we are getting is from the discounted price that we are buying them at. A fixed rate bond currently priced at 102.9 has 1 year remaining to maturity and is paying 8% coupon. Please note, coupon is always on par value. Par value of a bond is always either 100 or 1000. From the scale of the question, you will be able to guess what the par value is. In a question like this, where the price is 102.9, we will assume the par value of the bond is $100. Assuming the coupon is paid semi-annually, what is the yield on the bond? So first, let's depict the cash flows from this bond and then try to calculate the yield. So now it's a different problem because the price is given to us. So 102.9 is given to us. The cash flows are given to us. That is 8% by 2 into $100, that is $4 at the end of 6 months, because 1 year is remaining to maturity. And then at the end of 1 year, another $4 plus $100 at maturity. The first cash flow is coming at the end of 6 months. So it will be discounted back at a semi-annually compounded rate for a period of 6 months. So if y was the annualized yield, semi-annually compounded, then 1 plus y by 2 to the power 1 would be the discounting happening at t equal to 0.5, and 1 plus semi-annually compounded yield upon 2 to the power 2 is a discount rate that will be applied to the second cash flow that is coming at the end of 1 year. In this equation, there is just one variable that can be solved. We will take help of the cash flow sheet. So we will enter n as 2 since there are 2 periods remaining. We will enter the present value as minus 102.9. Please note, you have to enter either the PV as minus or the PMT and FE as minus. The PMT at the end of each year is, at the end of each period rather, is $4, and the future value at maturity is an additional $100. This is the information given. We have to compute the periodic discount rate for each of these 2 periods. So we will compute I by Y. So let's do it. Press 2 and press N. Press 102.9 and press PV. Press 4 and press PMT, press 100 and press FV, press the button compute and press I by Y. We get the I by Y as 2.4955 or approximately 2.5%. So the periodic discount rate comes out to be 2.5%. That is, YS by 2 is equal to 2.5%, or the annualized semi-annually compounded yield would be 2 into 2.5, that is 5%. Remember, rates are annualized. Compounding may be annual, semi-annual, quarterly, or anything. gives us the answer as 5%.